Alphabet Inc. made waves in the financial markets by raising nearly $32 billion in debt within a single 24-hour window, a move that underscores the immense capital demands of the ongoing artificial intelligence arms race among technology giants. This massive bond issuance included a rare 100-year sterling note, the first of its kind from a tech company since the late 1990s dot-com era, signaling both Alphabet's aggressive long-term vision and investors' growing willingness to back such extended horizons. Notably, the sterling tranche alone set a record as the largest corporate bond sale ever in the UK market, reflecting the scale and ambition behind this fundraising effort. This debt sale came on the heels of another $20 billion offering by Alphabet earlier in February 2026, illustrating the company's urgent need for capital to fuel its AI expansion. Alphabet's capital expenditure forecast for the year has nearly doubled to an estimated $185 billion, a figure that dwarfs previous years and highlights the escalating costs of building AI infrastructure, data centers, and next-generation computing platforms. The company's strategy clearly involves securing long-term financing that matches the extended timeline required for research, development, and deployment of advanced AI technologies. What makes this issuance particularly remarkable is the inclusion of the 100-year bond, priced at 120 basis points above the yield on 10-year UK government bonds. This ultra-long maturity attracted nearly 10 times the amount of investor demand relative to the bonds offered, a clear testament to Alphabet's strong credit profile and the market's appetite for stable, long-duration assets amid persistent economic uncertainties. Institutional investors spanning asset managers, hedge funds, pension funds, and insurers eagerly participated, seeking yield and security in a low-return environment, despite broader concerns about rising global interest rates and inflationary pressures. The scale of this operation can be distilled into three key figures: $32 billion raised in less than a day, a century-long maturity rarely seen in tech finance, and demand exceeding supply by nearly tenfold. These numbers not only reveal Alphabet's financing needs, but also reflect a broader market dynamic where investors are increasingly willing to commit capital toward the AI-driven future. This bond sale is emblematic of a new era in corporate finance, where technology firms are leveraging the debt markets to sustain multi-decade growth trajectories. Beyond Alphabet, this borrowing spree is part of a larger industry trend among hyperscalers and tech giants. Oracle recently raised $25 billion to support its AI initiatives, while Meta Platforms and Microsoft have announced capital expenditure plans exceeding $150 billion combined for 2026. Morgan Stanley projects that total borrowing by hyperscalers, major cloud service providers like Amazon Web Services, Google Cloud, and Microsoft Azure, could surge to $400 billion this year, more than doubling the $165 billion recorded in 2025. This collective surge in debt issuance highlights the critical phase of infrastructure build-out necessary to maintain competitive advantage in AI and cloud computing. However, the rapid escalation in corporate borrowing has sparked debate among market participants regarding the sustainability of these funding levels. Analysts warn that the sheer volume of debt could strain bond market valuations, especially as more companies flood the market with long-dated instruments. The issuance of a 100-year bond, a rarity last seen in tech with Motorola's 1997 deal, raises questions about market maturity and whether investors can realistically assess the risks and returns of technology business models over such extended horizons. This skepticism is compounded by concerns over the potential for diminishing returns on massive AI investments if commercial applications fail to scale as expected. The decision to issue a 100-year bond also reflects Alphabet's confidence in its future cash flows and the belief that AI will underpin its business for generations. Such a long maturity allows the company to lock in historically low borrowing costs, while matching debt service obligations with the anticipated long-term payoff of AI research and infrastructure. This approach contrasts with the more typical 5 to 10-year maturities seen in tech debt markets and signals a strategic bet on sustained innovation and market leadership through 21-26 and beyond. Investor enthusiasm for Alphabet's offering also provides insights into broader capital market trends. Despite a challenging macroeconomic backdrop marked by rising interest rates and geopolitical uncertainties, investors remain eager to back high-quality issuers with strong credit ratings and clear growth narratives. The oversubscription of the bonds suggests that the hunt for yield in a low-return environment is driving demand for longer-duration, investment-grade debt, especially from sectors perceived as critical to future economic growth like technology and AI. Looking forward, Alphabet's massive debt raise sets a precedent for how tech companies might finance their AI ambitions in the coming years. The company's strategy of securing multi-tranche, multi-currency debt with a wide range of maturities offers flexibility and diversification, helping to mitigate refinancing risks and currency exposure. This approach may influence how other hyperscalers and AI-focused firms structure their capital markets activities, balancing the need for immediate funding with long-term financial sustainability. The broader implications of this borrowing wave extend beyond Alphabet and its peers. The surge in AI-related capital expenditures and debt issuance is reshaping the technology sector's financial landscape, with ripple effects on bond markets, credit ratings, and investor risk appetite. Market watchers will be closely monitoring upcoming corporate earnings reports and capital expenditure disclosures to gauge how these massive investments translate into revenue growth and profitability, which will ultimately determine the viability of this debt-fueled expansion. Questions remain about who bears the greatest risk in this evolving environment. Bondholders face exposure to long-term credit risk amid uncertain economic conditions, while companies must balance aggressive investment with disciplined financial management. Moreover, sectors linked to AI, such as software-as-a-service providers, hardware manufacturers, and cloud infrastructure companies, may experience varying impacts depending on how capital flows and technological adoption evolve over the next decade. Alphabet's $32 billion bond sale also highlights the intersection of technology innovation and capital markets innovation. The re-emergence of century bonds in tech finance challenges conventional wisdom about corporate debt horizons and invites a re-evaluation of how companies fund transformational projects. This could inspire other sectors with long-term investment cycles, such as renewable energy and infrastructure, to explore similar financing instruments as they seek to align capital structures with strategic timelines. Meanwhile, the AI hardware shortage, exemplified by soaring stock prices for companies like SanDisk, which jumped plus 1,747%, and Western Digital, up plus 455%, adds another layer to the investment equation. The demand for specialized chips, memory, and storage solutions is driving supply chain adaptations and capital allocation decisions that will influence technology firms' growth trajectories and financial performance. Alphabet's debt raise can be seen as part of a broader ecosystem effort to secure resources for the AI century. As the tech sector continues to evolve, Alphabet's unprecedented bond issuance serves as a bellwether for how innovation, capital, and market confidence intersect. The company's long-term borrowing strategy not only fuels its AI ambitions but also signals to investors and competitors alike that the race for AI supremacy is as much about financial engineering as it is about technological breakthroughs. This dynamic will shape the contours of the technology landscape for decades to come. For those tracking these developments, the coming months will be critical. Monitoring bond market performance, credit rating changes, and capital expenditure trends will provide valuable insights into how well the tech sector manages this wave of debt and whether the promised AI revolution delivers sustainable returns. The interplay between innovation and finance will remain at the heart of this story as Alphabet and its peers navigate an unprecedented era of investment and transformation.